the most common trap zone is the trap zone between your two key moving averages. So let's say you have a 200 here and you have sort of like a 20 here. This will be a very common trap zone where your stock is actually between the two key moving averages. What a trap zone in essence is you have something significant that is above the current price, like the 20, and you have something rather significant below the price activity, like the 200. It's also important to note that moving averages, like everything else, they are zones or areas. They're not specific points or specific prices. That is why I'm demonstrating the moving average areas more as zones. And so you're always in a trap zone when something significant, not insignificant, something significant is above the price and something significant is also below the price. And this will tend to trap your stock between the two things that are significant. Now, it's not that it can't go through any of these things. That's possible. But the probability is that you get some type of pause at or near the significant thing, or some type of pullback, or some type of difficulty when there's something that is representative of resistance above you and support beneath you. All right. So this is the most common trap zone you'll see. Two major moving averages. Our major ones are the 20 and the 200. And boom. When you have this trap zone, the further a stock drops or rallies to one of the items, the more significant that item of support or resistance is. Let me give an example of this. If your stock has fallen a distance to reach the 200 is much more powerful. So if the stock has come a long way, if it's come from the heavens and then dropped to the 200, that 200 is far more powerful than starting from here. All right? Make sense so far? You see, that's come from way up here. This one's come from here. This is more powerful scenario. The 200 is far more powerful as support when a stock has been traveling a while to get to it, or from way above. Of course, this is the same in reverse. The item that's making the top of your trap zone is far more powerful if your stock has come a long way or come from way below to get to it. If it didn't come from way below, like this, and it started to move up from here, it's not as powerful because your start is from here versus your start from here. That's something that's very important to understand. You can be in a trap zone, but you need to understand when the trap zone support or the trap zone resistance is the most powerful and when it's not as powerful. Right. So what I mean by powerful, meaning that it's going to be more of like a brick wall or concrete ceiling. Like it's going to be hard for this one to get through resistance, having traveled so far to get to it. This is going to be much harder to get through the 200, having traveled so far or from so far above to get to it. It makes your trap zone more powerful. That is trap zone type number 1, moving average trap zones. You have price and moving average trap zone. Let me give you that example. And we'll summarize these two as well. Price and moving average combo trap zone is like this. Let's say you have the 200 and then you have your stock. And let's say you've got a 20, something like that, but your stock has come from up here. It's fallen sharply. Boom, 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 and it's come off. This is the price moving average trap zone. See, the first one was moving average trap zone between two moving averages. Now you've got moving average price. What's the price? Where the beginning of where your stock collapsed sharply from creates this zone of resistance. The origin, what I like to always say, the origin of pain. Where did pain begin? Pain started for the longs. Pain started right there. Boom! They started feeling the pain if you were long. Where was the beginning of that pain? Where did the collapse start from? What's the origin point? That origin point is a zone, is an area. You can extend into the future from that origin area and know that that is a negative, pain-filled memory point. That if the stock were to come up to that area, it would typically have a hard time getting through. The moving average support is beneath you. The overhead pain point of resistance is above you, and the stock is now trapped between both. You got this one? Price, moving average, trap zone. This was the moving average one. Moving average, moving average. This is moving average, right? And this is price moving average. Now, this is the same in reverse, guys. So the same in reverse, right? With the price moving average. Don't forget that. So, for instance, you can have something like this. Here would be the reverse, moving average, and your stock. Boom. So your stock sharply rallies. This will create a supportive memory point that your stock is now stuck between the 200 above it and this sharp reversal memory point. If this is the memory point of pain, this is the memory point of greed. So basically, this sharp move up here gives buyers confidence if the stock comes down there to try to nibble again. All right. So support, price support, moving average resistance, price resistance, moving average support. So remember the two types here, guys. Remember, you can have moving average trap zone. You can have price moving average. Let's do it like that. Okay. And of course, this price one can be reversed. Your moving average can be the resistance. Your price bottom can be the support. Then there is the final one. So there are three types. These are two types. Type 1, moving average, trap zone. And then you've got price, moving average, trap zone. Then you have price, trap zone. Price, okay? Moving average, trap zone. Price, moving average, trap zone. Price, trap zone. Let's go over price. So let's say, for instance, you had a 200 here, and the 200 was ignored, but the stock sharply dropped hard. Boom, boom, boom. So the origin of that drop is resistance, a memory point filled with pain. If there are people still holding on for dear life from up here, they got caught long and they got slammed. Boom, boom. If the stock were to ever, they're hoping and praying, if the stock were to ever come close to them getting their money back, they would have a high propensity to sell. This is what creates the resistance. The people holding on are big sellers if the price comes back. Okay? So, price is when you have a sharp, violent drop creating this pain memory resistance zone. And you also get, boom, a sharp rally. So you've got now the bullish memory zone serving as support, and you've got the bearish memory zone serving as resistance. So your two key items is a pain memory point and a greed memory point, or a bearish memory point serving as resistance, or a bullish memory point. And now your stock will have this tendency of vacillating between these 2 points and not getting through. This is the price memory point. Moving averages have nothing to do with it. So do you have the 3 different types? Moving average, moving average. Let me do little versions of them. Price, moving average. And you have price. The 200 doesn't have to be there. I just, like, you don't need a 200 to have price. I show you the 200 there because I wanted to show you that in this scenario, the moving averages don't matter as much as the 2 points of the origin of violence. This is the origin of violence to the downside. This is the origin of violence to the upside. And now you're trapped between two origin points for violence.